We talked about Lone Pine Cafe A part of it, that is the question of opening balance sheet. We talked about the first two paragraphs talk about purely the opening balance sheet as to what is there and what was not there, we took care of it and we accounted for it. Now, let me move to the closing part of it. When I move to the closing part of it, I think there are some confusions which are sort of popping up out there. Let us start with the first aspect out here, capital plus liability, what we had. We had capital of what is called as 16 into 3, whatever 16,000 into 3, that was about roughly 48, what we had was 48, I will just write these numbers out there. Then there was something called as mortgage. And the case also talks about part of the mortgage being repaid, that is what was your liability initially. Your liability initially was there was some amount out there, 21,000 was the liability, part of it is repaid. When part of it is repaid, what is the kind of liability that is there as of now? 21,000 minus whatever is repaid, that is liability as on the closing part of your balance sheet. So what is that amount? 21 minus 2,100, so that will be about 18,900, that is about 18.9. Then it also talks about something like there is some money which the cafe owed to what is called as the suppliers, that part of it was also there. I am talking about only liability as of now, we will go to the asset side a little later. There is something, what is the amount, sir? 1585, okay, 1583, 1.583, okay, you can just take care of that. You just take care of that, that is not a problem. Then what else was the liability? This is money owed. For purchases. What else other than that was the liability? Nothing, no other liability. Now there was what is called as cafe equipment. There are some things what you purchased. Go back to your opening balance sheet. If you look at your opening balance sheet, there are some things which you basically had purchased. Your license is, let us go to the fixed asset, even larger, equipments, etc. These equipments also had something called a depreciation, that is what that equipment, what is the value of the equipment as of today, that is what I am interested in. The value of the equipment as of today is whatever the value at which you have purchased minus the depreciation part of it. Am I with you? So what is the total final value of the equipment? 50,000 was the original value, 5755. This 5755, how did you get, sir? What is the equipment cost you have taken? 53,200 minus your depreciation part of it, agreed, because that is a slightly combined one what you have. Now what else was there? There was something, it says that there was what is called as the food that was basically left out there, the kind of food that was left out there, that is the food in the sense the cafe, what do you call it, a stock of inventory, that is the kind of inventory that is left. What is the value of the inventory? Inventory. Then what else? Cash and cash register. There was a confusion with regard to cash and cash register. Somebody said cash register is stolen, am I right, Muralikrishnan? Right? You said cash and cash register both are stolen, so why should we take it into account? Now supposing you recover the cash and cash register, it belongs to whom? It belongs to the company. So who owns it? Company owns it. When the company owns it, then naturally what happens? As of today, stolen. Stolen is a different event, don't mix both. You are basically the cash and the cash register is owned by the cafe. The fact that it is stolen is a different event by itself. Sir, I may not recover. The day you decide you will not recover, you will write it off as a loss on that particular day. As of that whatever last day you are preparing, 31st or whatever is the day, you have not declared that it is irrecoverable. Have you declared it as irrecoverable as of today? No, you have just said it is stolen. We do not know whether it is recoverable or irrecoverable. The day I decide it as irrecoverable, then I will write it as a loss out there. As of today, I have not done any of that. I have said it is stolen. Stolen is an event that has occurred. But today, moment, the same evening, you recover that. then it belongs basically to the cafe, not to the people who have basically stolen it. Am I with you on this? So, the cafe and cafe equipment will also, the value of the the value of the amount of cash that was there in the cash register as well as the cash register, value of the cash register will also be part of your asset of the balance sheet. Agreed? Then what else? Cash and cash register. Let me sort of look at my cash and cash register. Cash plus cash register. Pardon me, 311 and 1000? 311 and 1400, that is 1711. Am I right? Yeah, roughly about 1711. Yes, Muralikrishnan? 311 was cash, right? Cash in the register. 1400 is the value of the register itself. So, I have taken both together, right? Yeah, I mean, you have just said that. Joel, you got it? They have not mentioned. If it has depreciation, yes, depreciation will be taken into account. They have not mentioned any depreciation. So, we presume maybe there is no depreciation for it, maybe it is in high demand. So, they are not depreciating it. If they have, see, what are we recording? We are recording what is the value as of today, that is all. Then what else is left out? Bank or cash balance or bank account balance. Bank or bank account balance. What is the bank account balance? 1030. And then there was another statement also which said that the ski instructors owed something to the cafe out there. That is what you typically call it as debtors. 870, whatever, 870. Am I right? That is all. I think moral debtors. I mean, the people who owe you money are debtors. If you owe money to somebody, that is creditors. That is a subtle difference between the two. Now, you just total up the asset side and total up the liability side of the balance sheet. Unused license. License initially what you had paid how much for the license initially? 1428, and that was valid for 12 months. But how many months has lapsed since the cafe has started? 5 months. So, the license is still usable for 7 more months out there. So, that is something as an asset. Either you use it for 7 months or you sell it to somebody for 7 months, right? That is something which you own. That is unexpired license. 833. I think more or less we are complete out there, because I based on memory I just called out the aspects out there. Now, yes, Hazirika.
What will happen if the license is not transferable? I mean, you cannot sell.
If the license is not transferable, license is cannot be sold, then it is not an asset anymore. That's all. It is not there on your asset side, obviously. Moment it is not there on your asset side. Now what happens? I'll answer your question in a minute's time. Now you have the total of your assets, you have the total of your liabilities. When you have the total of your assets and the total of your liabilities out there, you clearly see that the total of your asset side is what is called as less than the total of your liability side. That is what all of you found there. Liability plus capital. In short, what I am trying to say out here, the sources of fund, that is the capital plus liability, which we typically call it as the source of fund out there, is much more than the way in which you have basically utilized the fund as of that particular day. So, there is what is called as an inefficient utilization of the source of fund. Yes, sir. Any problem? Following, sir? So, there is what is called as an inefficient utilization of the source of fund. You remember that example of the toy and the monkey, which I had sort of given right in the first class out there. You make an efficient utilization, that is, I borrow $100 from you, I try to make a toy and sell it, and I sell the toy for 120. I borrow 100, that means it is a liability of 100. I make a toy. Supposing I sort of convert that to a toy and sell it for $150 to him, he buys it for $150 and then he owes me money. Then what happens? There is a debtors of $150 on the asset side, there is a liability of $100. What I have done? I have made an efficient utilization of the source of fund. Source of fund is borrowing. The sale is where I utilize the fund. I made an efficient utilization. When I made an efficient utilization, what do I make? The profit I made, it gets flowed back to the capital provider. In that case, the debt provider, $50 equity or whatever he has provided, it gets flowed back to him. So, your balance sheet sort of takes care of it. Debt provider will not get a share in the profit. Let us keep it as equity provider in that case. Supposing I had made an inefficient utilization, I was able to sell it to him only for $80. That means there is a $20 loss that again will be borne by the equity provider. Supposing he is the equity provider, he has provided that $100, he will basically bear that loss out there. So, in this particular case, the assets, the value of the assets are far less as compared to the liabilities. So, what happens? The remaining part of it, the difference part of it will get deducted from the capital out there, the capital of 48,000 out there. Now, if the cash register I declared it as a loss and it was not there, then what happens? If this is also not there, then your loss will obviously increase out there. That is all. Supposing somebody says the food gets spoiled out there, the inventory of food gets spoiled out there, then that cannot be called as an asset. Do not call it as an asset. Then what happens? Your loss basically obviously keeps on mounting in that particular case. That is all what happens. Now, how does the third question of that particular case, if you see, how do the partners divide what is the kind of capital what they have, what is the kind of ownership what they have, or what are they eligible to get? In a partnership, unless until otherwise specified, the profits are divided equally. Unless until otherwise specified, irrespective of the capital contributed by you in a partnership, not in the equity share. In the equity, it basically depends on what you call it as what you are eligible is basically divided by the number of shares out there. In a partnership, this is a pure partnership out there. So, each one will, the loss will have to be split equally between the three, and in this particular case, luckily the capital contributed by all the three is also the same out there. The capital contributed can be different, but if there is no specific mention in the partnership agreement, still the loss or profit will have to be divided equally out there. Am I with you on this? Any questions on this? Yes, Joel.
The capital is different, sir. Some ratio they are paying. The capital. Then how?
Supposing the capital, each one, they, despite the capital, equal capital out there, they decide that the loss or profit will be split in the ratio of, let us say, 3:2:1. Then whatever is the loss, you just divide it in the ratio of 3:2:1. Whoever has to get the third share, 1/3 of the share, they get it. Whoever is to get the second share, they will get it, and whoever is to get the share, they will get it. That is, it is a profit or loss, the ratio will remain the same. You cannot say for profit I will have this ratio, for loss I will have this ratio. Possibly you can have, provided you are able to establish that in your partnership agreement and so on and so forth, etc. With you on this, Joel? Yes, Naresh, right? Yeah. Okay, fine. No, has it been repaid as of now? No. Where does it say it is repaid? Where are they? They are not even there to repay for you. They have run away. So, as of now, they are eligible to get so much. That is what I have done accounting treatment. I have not repaid. Moment I repay, this is not a liability anymore. None of these assets will exist. I have got to sell all these assets, convert it to cash and only repay. As of now, this is the money they are eligible to get. That is all. I have not repaid anything. As of today, closing balance sheet, this is the position of my asset, this is the position of my liability. That is all. There is nothing else. With you on this? We move ahead to the next step. Yes, Rishabh.
When we say that food is spoiled and we are charging it off from.
No, I never said food. If you consider.
In case if it is spoiled and we are charging it off from the balance sheet, so on the asset side it will become 0, it will go to P&L. On the capital side also there will be a change in that?
No, in the sense, what happens? If this goes off, food goes off, whatever is the balance of inventory out there, if this goes off, then what happens to your, now if you calculate your profit or loss, now what happens? Your asset side total will be even lesser. So the loss will be even higher. That is all.
So loss will get booked here against the capital.
Obviously, right. Loss is getting good. But see, when you calculate the P&L and carry forward the loss, or you do it this way, it is going to be the same. Now, you have arrived at the loss out there, right? Now you need to verify whether it is right or wrong. So, take up Lone Pine Cafe B part of it, Lone Pine Cafe B part of it. Just open that and read it for 2-3 minutes, then we will try and solve it. Lone Pine Cafe B, Lone Pine Cafe B, that will be in chapter 3. Chapter 3. I'm sorry, unfortunately or fortunately you guys have to carry both the textbook as well as my material for my classes, at least the first year. Now let's get to this. In addition to preparing the balance sheet described in Lone Pine Cafe A, Simpson the accountant agreed to prepare the income statement. He said that such a financial statement would show Ms. Antonio how profitable operations has been and thus help her judge whether it was worthwhile to continue the operation of the restaurant, because she was trying to continue the operation of the restaurant. In addition to the information given in A case, Ms. Simpson learned that cash received from customers through March 30th, that is till March 30th, cash received from customers till March 30th, through March 30th is till March 30th, was about $43,480 and cash payments were as follows. So when you have received cash from customers, why do you receive cash? Normally on a sale, not as advance. In this case, normally only as a sale. So naturally what happens? Cash received, that is basically sales, is 4380, first thing. Now is it only 4380? As of now? Is it only 4380 is the sale? Is only 4380 is the sale? 800 and? Why Jai Kumar? Beautiful. There is something, see this is a cash you have received. There is something which you are yet to receive, that is also a part of the sale, right? You go back to the closing balance sheet, what we did. 833 is the money that you are yet to receive. 87 whatever, that 800 and dot is the money which you are yet to receive. That basically also is part of your sale. What is sale? Irrespective of whether you have received or not, the event has occurred, that is what is a sale. So actual sale value will be 4380 plus that amount that you are basically about to, what do you call it, as you were to receive from the ski instructors out there. Am I with you on this? So far so good. Now let us look at the expenditure. It is a very simple thing. If you look at the expenditures, monthly payment to partners were 23,150, one third to each partner. Let us keep that aside, let us go to the other one. Wages to part time employees were 5,480, that is an expenditure, right, expenditure. Interest was 540, expenditure. Interest on the mortgage is an expenditure, whether you are paid or not paid. In this case you are paid, you are writing it as an expenditure. Food and beverage supplies 10,016, 10,016, right? Food and beverage you have bought, purchased 10,016. Is that the expenditure? Go to the balance sheet. Inventory is different. Inventory, let us not worry about the inventory. It is the expenditure. Then, now why minus the inventory? It can still be used, agreed, but there was opening inventory, fine. Now, we are not worried about inventory as of now. We are worried about what you have paid. Basically, if you look at your purchases as such, there is some money which you are still owing for, which is still owed to your purchases out there. You can just look at it. Basically, what is your total purchase? Your total purchase is this 10,016 plus 1583 is your total purchase out there. Am I right? 10,000 is actually cash paid and remaining, so 1500 is still a liability, that is you have made a purchase, right. So what is your total purchases? That is what he has got it. Inventory part of it, we will worry about it little later. What is the inventory part of it?
It's added in food and beverages.
It is added. Now, yes, Smita, any problem? There is no formula, it is only addition. See, again I repeat, what is the cash that is paid to suppliers? 10,016 is the cash that is paid to suppliers. What is the cash that you are yet to pay? 1,000. What is your total purchase? 10,016 plus your what you are yet to pay. That is all what I have taken, nothing, no rocket science. Inventory, don't worry, we will take care of it. Inventory is also adjusted out there. Let us not worry about it.
But it is 10,016, right?
Ah.
Plus 158. The addition, correct? 115.
Well, that is, this is the first part of it. Don't worry, next part of it. What will, 1 second sir, hold it, 1 second, don't worry. I am going to go step by step because I have to carry at least take 75 to 80% along with me, okay. Now what is the next step? Next step is, first up we talked about what is the total purchases. What will go in your P&L? In your P&L, you will record only that part of the amount which is utilized during that period for which you are preparing the P&L statement. Now, all the purchases have you utilized? No. There is something still remaining in the stock that you are basically not utilized. That first thing what you have to do? You have to deduct out there. Have you done it, Pratik? In addition, 1 second, hold it, Swapnika, 1 second. In addition, you had recorded something, you had bought some part of the goods out there or supplies when you started the cafe, when you opened the cafe on the first part of it. That also you might have utilized. That is also basically what is your total supplies out there in this particular case. Just go to the other plain blank sheet. In this particular case, if I have to see that, let's move away from here. Supposing there was an opening stock of 100, cash purchase during the year was 1000, credit purchase during the year was 700, closing stock of during the year was 150. What is the utilization in this particular year? It is, what is the total amount of inventory available for you? 700 opening stock plus 1000 what you have bought through cash plus 1000 plus 700 what you have bought through credit. So, total amount of supplies available for you is 1800. Am I with you or not? 150 is still the closing stock which is still left with you. That means how much you have utilized? 1650 is what you have utilized. Yes or no? That is what will come into your P&L. Yes or no? Now go to the Excel. Now keep your cursor there. Keep your cursor at 1169. So what has it done? First part of the amount is what you have paid in cash. Second part of the second figure out there is basically what is still to be paid out there. Am I right? Is that the way you have taken? Yeah, he has added, okay. The last part of it is that. Do it in sequence. Now what is the second amount out there? Second amount 2800 is basically the opening stock that was there. That is the stock with which you started the basic operation. The next third amount what you see out there, that is about patience Pratik, don't keep changing. Once you have entered, leave it that way. Now if you change it, then see, now again it's the second part, right? Don't, once you have entered, leave it. I will adjust it accordingly. Now you do it. Can I open the balance sheet? Go to the other sheet. Okay. This part of it is clear, right? Now there are some food and beverage that is gone out here. You just open your Lone Pine Cafe A, you will see what is the food and beverage that was there, left out. What is the food and beverage that was there? 2430 was basically, go to the Excel. 2430 was basically the closing stock. That yes, reduced, you will see minus. The figure before that, 2800 was the opening stock. The first figure is basically the cash purchase. Second figure is basically the credit, that is money which is yet to be paid out there. With you on this? Now how are we in sync out there? How we are getting the expenditure part of it? Now move ahead. Telephone and electricity, you have paid some amount, 3270. Yes, please. Yes, sir. Any problem? Sure. Okay. Miscellaneous expenditure 255. Rent is 7500. Yeah. Yeah, that is what till March 30th. That is what they have clearly stated. That is they have, for that period, the day opening of the cafe till the 30th of March, whatever is the day the cafe closed down. This is not per month. They have not given. They have given a complete statement for the entire period out there. Am I with you on this? All the months put together. That is where the first statement is, before you read that, it says that it is the expenditure, cash payments through March 30th, till March 30th. With you, sir, on this? Expenditure in a P&L is that which account basically for which is accrued as an expenditure. You are not, you might have spent, but what you have utilized, accrued during that particular period. I might have spent, in this particular case, the total amount of purchases I have spent is 10,000. Go to that, keep the cursor there, is 10,016 plus 1583. But what I utilized might be more than that or less than that. It will be more than that provided I have taken lot from the opening inventory. It will be less than that provided I keep a lot of inventory out there. In this particular case, you actually see it is more than what is your purchase, because you have drawn from your inventory also. Am I with you on this? So far so clear? Now, Menard Company A and B, you will have to do it on your own. I am not trying to revisit Menard Company A and B. Okay, Vishali? Vishali, right? Yeah, okay, fine, that's good. Yes, Joel, any problem? Sure, perfectly fine. Okay, that's great. Now we move to the, any doubts on P&L and balance sheet? I am not going to revisit P&L and balance sheet anymore. I am not going to revisit P&L and balance sheet anymore unless you have a doubt as of today. Yes, Navya. What does the? Now you have to calculate what is the profit or loss. Can you calculate the profit or loss? Which one? Yeah, you can say payment to partners. We have taken, he has not added. Okay, you have to add that. That is the first statement that was there. I am sorry. That is the first statement that was there. Salaries to partners, net payment to partners monthly, whatever is the amount. 23,150. Now this is the loss. Go to your, one second, go to your balance sheet, closing balance sheet, match it with the same, does the loss figure match? If the loss figure does not match, then we have a problem. Does it match? It doesn't match, right? Why doesn't it match? Tell me now. Why? Which one? No. No, what are we preparing? We are preparing only profit and loss statement, right? We are trying to find out the profit. We have taken the income, we have taken the expenditure. The difference is profit or loss. That is what we will go to the balance sheet. Now, why is the loss, not loss figure, what you have got here, not matching? Depreciation is not a cash payment. Depreciation is a non-cash expenditure. That is, the value of the assets has depreciated during this period of 5 months of your cafe's operation. What is the value of your total depreciation? That is a non-cash expenditure. Put that. Now figure matches. Then the other aspect out there is license fee, that also you utilized out there. I will come to the explanation. There is some confusion for Swapnika. I will come back. Let him finish that, then let me come back. Now it's fine. Now I go back and explain each of this. Now you can concentrate here, you can stop writing for a few minutes. Idea is, now what you see out here is all the expenditure that has accrued for that particular period. I use the word accrued here. In this case, the license fee or the depreciation, she can argue, Swapnika can argue that it is not the money that has gone out of the company, perfectly fine, but it is an expenditure, that is money has gone out in the capital purchase initially. That part of the money, some part of that expenditure you are utilizing for this particular period of 5 months out there, the cafe operation. That is, you put the title as profit and loss statement for the period, whatever, the opening of the closing and the closing date out there. So, these expenditures have accrued. The license fee, 5 months of license fee you have enjoyed during this particular period. So, that particularly pertains as an expenditure that has accrued for this particular period. Am I with you on this? That the same doubt you had? No? In this particular case, if you read the case case A, it clearly says that there was partners are eligible for some salary out there. So, I am considering it as a salary. Otherwise, instead of putting out here, I would have reduced it from the capital if it was withdrawings out there. That is why I have considered it as a salary out there. So, in this case, even this food and beverage, why was so much of adjustment? Keep your cursor here. Not as on March 30th for the period. Now, in this particular case also you see this. What have we calculated? We have calculated what is accrued for the period, what is pertaining to that particular period, not what all the food and beverage that you have bought does not pertain into the same period. No, not food and beverage. Food and beverage there is no depreciation, there is only consumption. Consumption. What pertains to the period? What pertains to the period? Whatever I have bought minus whatever is left over is what I have consumed. But there is also some stock which was there when I started the cafe, that also. So, what have I consumed? Whatever I would have bought plus whatever was there at the beginning, all these are available to me for consumption. So, what have I consumed actually? What was available to me minus what is left on the stock is what I have consumed out there. So, in this particular case, you see there is a, keep the cursor here, there is a cash purchase, there is a credit purchase, that is both the purchases. Then there is a inventory out there, the third aspect, inventory is there, that means that these three put together is the total quantum of food supplies available to me during this particular period. What have I consumed minus what is still left over is what I have consumed. That is what pertains to this particular period, November to March, what he has given out there. So, what we are recording in the P&L is only whatever expenditure that has accrued irrespective of whether cash has gone out or not. Why cash has gone out or not? If you look at your what do you call it as food and beverage also, that is there is some amount yet to pay. The same thing we are doing with the income part of it also, yet to receive, but it has accrued. There is no depreciation in the opening stock. Depreciation, that is what is called as your stock, value of the stock that is there. In a stock we do not call depreciation, is normally for what is called as long term assets. This is, for example, you have fuel which can, or liquid nitrogen. 30th of March evening you close down, there is some amount of inventory. 1st of March when you open, there is some amount which has gone out for as evaporated, that right. So, your inventory decreases, that is all. Your inventory just decreases, the rest of it is part of normal loss. There is a part of normal loss if you are handling liquid nitrogen.
Basically, you're saying that's not a depreciation, but that's a loss.
That is a loss, that is what is used, that is all. Am I with you, sir? So, 1st of March, 30th of March I have taken inventory, 500 liters of liquid nitrogen. 1st of April evening I am again taking the inventory. The liquid nitrogen is of, it was 500 liters, has come to about 400 liters. But you actually think back and see, in the production I have used only 70 liters. What happened to the other 30 liters? It is gone. But what is your consumption? Consumption is 100 liters, that is all. With you on this? Amortization, I explained the other day. Amortization is what you call it as I said, I create some kind of a preliminary expenditure, I create an ad expenditure. I said I used the example of one of your movie stars out there. Now that is what is called as unamortized. Until unless I write it off in the P and L, it is unamortized, sitting in the miscellaneous and expenditure side of the balance sheet. Whatever part I write it off every particular year, for example, I am going to, there is a 10 crore investment on that ad, the benefit of the ad is going to be there for 10 years. Every year I am going to write 1 crore in my P and L out there, write off as an expenditure. So I am amortizing out of the 10 crore, 1 crore as an expenditure amount. Depreciation is not an amortization. Depreciation is a physical asset which can be bought and sold. An ad, as I said, Kingfisher logo, I think I used all these examples if I am not wrong. That cannot be, it will not be beneficial for anybody. Preliminary expenditure of starting the industry. You might have spent 10 crores in getting your license and taking care of many of the aspects out there. Now, you cannot sell it, it is for you, right? That expenditure, you don't want to write it off in the right first year out there. If you write it off in the first year, then nobody will come in, there will be no investor out there for you. You will always keep it in your unamortized amount in the balance sheet and amortize part of it every year over a period of whatever time you decide as a company. With you, sir? Yes, Rishabh.
Sometimes we see in the P&L there is a line called change in inventory, which is positive, negative. How do we see that?
Change in the value of the inventory. Normally what happens when we say, as I said, principle of being conservative, first class. Whatever is the value at which we have either purchased or the value of the value of it which is in the market. Whatever is, whichever is lower, number 1. Number 2, change in inventory, that is change in value of the inventory that can happen. Change in inventory per se, it will occur. Normally what happens in this particular case, in this, what did we take? We took all these 4 together. Instead of that, I can just cut it out, create a row here. Just take only the purchases part of it here, only the purchases, only the 2 purchases out there. Enter. These are the total purchases. Now, the change in inventory, there was an opening inventory, there is a closing inventory. Whatever is the change in inventory, I record it separately. That is all what I do. Instead of putting it everything total together, if I purpose of me putting it together was to explain to you the process. Normally in the balance sheet they will record it like this, change in inventory. Am I with you, sir? Done? P&L and balance sheet? Fine. So you can take a quiz on that now. Good. Fine. Yes, Ashok. 1 second, sir.
If there is a abnormal loss, it goes to the
Not abnormal loss occurs rarely. Yeah, whatever.
if it occurs, it goes into the
It goes, everything will be written out here. Whatever is this figure, loss figure is what gets written in the balance sheet out there. It gets added or reduced to the capital out there, profit or loss, right? In that case, you can just do the balance sheet and calculate it. You can do the P&L, know how did you arrive at that loss and then carry it forward to the balance sheet also. That is all. What did we do? We just did the balance sheet initially. We found there is a loss, but everybody is amused why there is a loss. So what did we do? We did a P&L. But normal process, Pratishtha would have learned first P&L, then balance sheet, take this loss and add it, reduce it or add it to the capital. Perfectly fine. That is the process. Agreed. But you need to understand, conceptualize how basically this entire thing happens. That is why we sort of did this thing. Am I with you on this?
But some cases, the goods are not sold out,
Ah.
but it moved out from our manufacturing unit.
Ah.
It may be in the middle, it could be a conversion process may be required. So those items, how do we take it?
Sir, in this particular case, in the balance sheet, whatever I go to the balance sheet, go to the other part of it, go to the any balance sheet out there. Balance sheet, not the other one, move up, move down, okay. In this part of it, I will say inventory, finished goods or finished inventory in transit. What is the value? I will write there, that is all. Finished inventory in transit. It is in transit, no, it is midway. As of 31st of March, it is midway, it is in transit. Who owns it? You own it, it will appear in your balance sheet. With you on this? Part of inventory, but you need to know what is there in your godown, what is in transit, what is in your dealer's godown which is still owned by you, what is in your stockist godown which is still owned by you, because you need to have the value of all this. Accounting. You cannot just say everything is owned and I do not know how much, because supposing there is a fire in your stockist go down and all the goods destroyed, you need to know what is the value, right. Supposing it is in transit, there are cars coming all the way from Gurgaon, right, your Maruti. On the way the truck meets with an accident and the cars are destroyed. Who bears the loss? The dealer bears the loss, or the purchaser bears the loss, or the company bears the loss? Dealer. Why? Has it been sold? Insurance is later, sir. Who will claim? Okay, insurance fine. Who will claim insurance? Should the company claim insurance, or should the dealer claim insurance, or should you as a purchaser of the car claim insurance? Depends on the agreement. If after the sale it is the dealer's responsibility to ship the car, then the dealer's responsibility. It is the company's responsibility till the doorstep of the dealer, it is the company's responsibility. If for example you are buying a Rolls Royce customized, so specially shipped for you and already registered from the factory, then your problem, right. It all depends on what is the status on that day, that is all. Who owns it? Who owns it at the point of time of the incident? With you on this? Now, as of today, I have lodged a claim with 2018-19, I have lodged a claim with insurance for 50 lakhs. I have not received, there is a loss for me. I write it off as an expenditure, abnormal loss in the P&L statement for 18-19. 19-20, insurance company wakes up and gives me the money. 19-20 P&L statement, I will record it as a money receipt from, that is the loss which was written off in the year 18-19 received in the year 19-19 from the insurance company. So, it will get added to your income of 19-20. With you on this? Yeah. But you have claimed the benefit of it, no, in the previous year. Now you are detailing.